Okay, let's unpack this. Imagine a retail sector where, for years, the headlines have screamed about stores closing, sales plummeting, businesses just battling for survival.
Yeah, it's been tough out there.
Exactly. Yet, tucked away in this, economic whirlwind, there's one specific type of store that isn't just treading water, it's actually thriving.
Really taking off in some cases.
We're talking about discount retailers, those champions of value who seem to just defy economic gravity.
Mhm.
And today, we're diving deep with a capital D into a fascinating major player in this space, B&M European Value Retail SA.
Hey, B&M.
You probably know them best from their bright blue storefronts, a leading operator primarily here in the UK, but also with a rapidly growing footprint across the Channel in France.
The French expansion is key. We'll get into that.
Definitely. To really get under the hood of B&M, we've pulled together a comprehensive stack of sources for this deep dive.
Good stuff.
We're talking everything from a meticulous investment analysis report to their latest financial statements and cutting-edge market research.
So, proper data.
Exactly. This isn't just skimming the surface. It's a deep, data-driven look behind the scenes, tailored just for you.
What's absolutely captivating here is B&M standing at a real crossroads,
Yeah.
wrestling with these monumental market forces that are fundamentally rewriting the rule book for how people shop across Europe.
It really feels like that.
Our mission today is to connect these dots for you, showing not just what's happening within B&M, but crucially, why it matters for its future value and position in this evolving market.
Yeah, the why.
Exactly. By the end of this deep dive, you'll have a concise, powerful grasp of the fundamental drivers behind B&M's business, its current challenges, the intensely competitive landscape it operates in, and its strategic direction.
Right.
You'll walk away well-informed on this dynamic and increasingly important retail sector.
That's the goal. But before we narrow our focus specifically to B&M, we need to zoom out a bit first.
Good idea. Context is everything.
Right. We need to fully appreciate the European value retail landscape. Trust me, it's a shifting tide, and the currents are powerful. Let's kick off with a truly compelling statistic that underscores just how much this sector is, defying the odds.
Okay.
The European discount retail market was valued at approximately $41.92 billion US dollars in 2024.
41 billion. Okay, that's big.
Now, that's a substantial figure in itself, but here's where it gets really interesting. That market is projected to grow at a compound annual growth rate, or CAGR, of 3.5%, soaring to an estimated $55.2 billion US dollars by 2031.
Wow, so steady growth on top of an already huge base. That growth trajectory is remarkable, wouldn't you say?
It really is.
Especially when you put in context. Over the past 5 years, say between 2019 and 2023, the broader European non-grocery retail sector actually saw its inflation-adjusted sales decline.
Decline, okay.
Yeah, by an average of 1.8% per year. Think about that.
So one's going up, the other's going down.
Precisely.
Yeah.
While most retailers were facing significant headwinds, shrinking sales, discounters were not just holding their own, they were actively pulling ahead, strategically gaining market share.
Right.
This clear divergence, this almost inverse relationship to the wider economy, really highlights the inherently defensive nature of the discount model.
Defensive, yeah.
It tends to perform exceptionally well during periods of economic uncertainty, acting as sort of a haven for value-conscious consumers.
Mm-hmm.
It really makes you pause and wonder, what exactly is fueling this massive shift? What's driving so many people towards value? Tag 1.2 key market drivers and evolving consumer behavior.
And that leads us directly into those key market drivers. It's not just a lucky break for discounters. We're seeing some truly fundamental shifts in consumer behavior and the economic environment. Tag 1.2.1 macroeconomic pressures. The most immediate and obvious driver is the persistent macroeconomic pressure weighing down on households.
Inflation, cost of living, yeah.
Exactly. Across Europe, we're experiencing stubbornly high inflation and rising living costs. These aren't just abstract economic terms. They hit people right where it hurts, their wallets.
For sure.
Research indicates that over 60% of European consumers are actively looking for opportunities to trade down.
Trade down. So switching brands or stores.
Yeah, exactly. What does that mean in real terms? It means they're consciously seeking lower-priced retailers for their discretionary spending.
Makes sense.
Think about it. Instead of buying that brand name sporting good, you might opt for a store brand alternative, or perhaps you're choosing a more budget-friendly option for new furniture, home decor, or even clothing.
Yeah, you see it everywhere.
And this isn't just a short-term sort of knee-jerk reaction to a temporary financial squeeze. Our sources suggest it's becoming an entrenched shopping pattern.
A new habit almost.
It impacts your shopping choices and your budget directly, and for many, it's simply a non-negotiable part of daily life now. Hashtag tag tag 1.2.2, cultural normalization of discount shopping.
Stepping back, the larger implication of this is a profound cultural shift in how consumers perceive and engage with discount shopping.
Right, it's not seen the same way anymore.
Exactly. For a long time, in certain markets, there might have been a subtle stigma attached to shopping at discount stores. But if you look at markets like Germany, where the modern discount model was pioneered by giants like Aldi and Lidl,
The originals.
and indeed across Central and Eastern Europe, discount shopping has long been viewed as mainstream, efficient, and, dare I say, smart.
Smart shopping, yeah.
It's about maximizing value, not just settling for the cheapest option. This mindset, which prioritizes value and efficiency over traditional brand loyalty, is now rapidly gaining traction in the UK and other Western European markets.
So it's becoming normal here, too.
Absolutely. It's no longer just about affordability. It's about making intelligent purchasing decisions. This really begs the question, is value becoming the new premium in consumer perception?
Interesting way to put it.
This cultural normalization provides a durable, long-term tailwind for the sector, suggesting that many consumers who have actively traded down during tougher times will likely continue to shop at discounters, even as their personal finances begin to improve.
They've found they like it, or the quality is good enough.
Precisely. They've discovered the benefits, found quality, and it's simply become a new habit. Hashtag tag 1.2.3, rise of private label products.
And a huge enabler of this cultural shift and a critical backbone of the discount business model is the phenomenal rise of private label products.
Own brands, yeah, they're everywhere.
European discounters have been investing heavily in developing their own brand offerings. We're not talking about those generic, often lower quality alternatives from decades past.
No, some are genuinely good now.
Right. These new private labels boast significantly higher profit margins for the retailers, which is fantastic for them.
Good for their bottom line.
But more importantly for us, consumers are increasingly trusting them. They're finding comparable, or in many cases, even superior quality at significantly lower prices.
You really notice it in supermarkets.
Think about it. How many supermarket-owned brands do you now prefer over the traditional national brands you used to automatically reach for?
Quite a few, actually.
This trend is actively eroding the historical dominance of those big national brands, giving discounters a powerful tool to differentiate themselves and compete not just on price, but increasingly on perceived value and quality. Hashtag tag 1.3, competitive intensity and market challenges.
So on one hand, we have these powerful tailwinds propelling the discount sector forward. But success, as we know, always attracts fierce competition.
Always does.
And this sector is certainly no different. Hashtag tag 1.3.1, market saturation and price wars. The very success of the discount model has inevitably led to a highly competitive and, frankly, saturated market in many areas.
Yeah, you see discount stores popping up everywhere.
We've seen aggressive expansion not just from established players, but also from new entrants, igniting what our sources describe as a relentless race to the bottom on price and quality.
Oof, that sounds brutal.
It is. This creates intense price wars, putting significant pressure on profit margins across the board. The market simply doesn't tolerate inefficiency.
No room for error.
We saw a stark and tragic reminder of this in 2023. With the collapse of the UK general merchandise retailer Wilko.
Yes, Wilko. Sad story.
Which serves as a cautionary tale of failing to adapt to this relentless competition and evolving consumer expectations. It's a brutal environment out there for those who can't keep up or innovate fast enough.
And adding another crucial layer of complexity is the ever-expanding digital frontier.
Right, the online piece.
While discounters have historically been very much brick-and-mortar focused, the broader retail industry continues its unstoppable shift online.
Omnichannel is the buzzword.
Omnichannel shopping, where you might research a product online, click and collect it, or browse in-store before buying digitally, is rapidly becoming the norm.
Expected, even.
Many European discounters are now actively investing in sophisticated online platforms and apps to meet this evolving demand. And this is precisely where B&M currently has a notable absence.
Of a significant digital or e-commerce initiative. Our sources highlight this as a potential long-term strategic vulnerability.
Yeah, that could be a problem down the line.
It's like having a fantastic car, but realizing everyone else is now flying.
Good analogy.
So on one hand, this sounds like a golden age for discounters, driven by changing consumer behavior and macroeconomic
Here's
pressures.
a lot of tailwinds.
But then we hit this wall of fierce competition and the gaping digital chasm. It's a classic double-edged sword, isn't it?
It really is a tricky balancing act.
And that brings us squarely to B&M. How exactly is their business model equipped to handle these powerful, conflicting forces?
Okay, B&M. At its heart, B&M operates as a general merchandise value retailer.
General merchandise, so lots of different stuff.
Exactly. They've really carved out a distinct and profitable niche in what's widely known as the value for money segment of the market.
That's their spot.
Their fundamental promise to you, the customer, is a vast, diverse range of both grocery and non-grocery products, all offered at highly competitive prices. Low prices, big range.
But how do they actually deliver on that promise while remaining profitable? It's underpinned by rigorous, almost obsessive cost control.
They watch the pennies.
They are incredibly disciplined in managing every operational expense and a methodical, focused expansion of their store network.
Right, the new stores.
This dual focus allows them to maintain that crucial price advantage, attracting a steady stream of budget-conscious shoppers. Management themselves describe this as a capital-light business model,
Capital light. Meaning?
meaning they don't tie up huge amounts of cash in expensive assets for long periods, which is key to its ability to generate significant cash flow and fund its aggressive growth plans very efficiently.
Ah, okay. Smart. Hashtag tag tag 2.2 operational segments. So how does B&M actually operate on the ground? As of the end of the 2025 fiscal year, the B&M Group runs 3 distinct operational segments, each playing a specific and vital role in the overall strategy.
Right. 3 parts.
First up, we have B&M UK. This is the foundational core, the biggest and most mature part of the business, currently boasting 777 stores across the United Kingdom.
The main engine.
Think of it as the primary engine for revenue and cash generation, and historically, it's been their most profitable segment. It's where the brand really established its roots.
Makes sense.
Then there's B&M France. This is their main international growth initiative, currently with 135 stores.
The big growth bet.
France is strategically seen as the key vector for future geographic expansion, tasked with replicating the successful UK model in a new, large European market. It's their big bet for international growth.
High potential, high risk maybe.
Could be. And finally, Heron Foods. This is a UK-based discount convenience store chain.
Oh yeah, Heron, seen those.
With 343 outlets operating under both the Heron Foods and B&M Express banners. It's specifically focused on the food-oriented convenience segment, offering a complementary quick shop proposition to the larger B&M stores.
So smaller, more food-focused.
Exactly. Each of these segments, then, plays a distinct strategic role, balancing the maturity and stability of the core UK business with the exciting, albeit challenging, growth potential in France and the convenience focus of Heron Foods. Hashtag tag 2.3 merchandise categories and sourcing strategy.
A critical component of B&M's widespread success and its broad appeal to customers is its exceptionally diverse and constantly refreshed product assortment.
The what they sell part.
Right. They truly embody a something-for-everyone approach. You'll find everything from fast-moving consumer goods or FMCG.
Like groceries, cleaning stuff.
Exactly. Like groceries and cleaning supplies, think your everyday essentials, to a wide array of non-grocery categories. We're talking DIY and decorating supplies for those home projects, electricals, household goods, gardening, and outdoor living items perfect for summer, pet care products, toys for the kids, and even some clothing.
A real mix.
And crucially, they have a significant and compelling offering of seasonal merchandise for events like Halloween and Christmas.
Ah, the seasonal aisle. Always tempting.
Which are massive draws and drive huge spikes in footfall. This dynamic, constantly refreshed product offering is specifically designed to create what they call a treasure hunt shopping experience.
Treasure hunt, yeah. Go in for one thing.
And you walk out with 3 unexpected bargains.
Exactly. This encourages customers to visit frequently, never quite knowing what new and surprising deal they might discover, and this strategy effectively drives both high footfall and repeat business.
Keeps things interesting.
But how do they manage to offer these low prices and maintain profitability?
The magic question.
It's directly enabled by an incredibly disciplined sourcing and supply chain strategy, which is relentlessly focused on cost control.
Back to cost control.
Always. Our sources highlight recent investments in this area, including the development of a new import center at Ellesmere Port aimed at improving general merchandise stock holding,
Right.
and the implementation of new systems for transport optimization. These are all about squeezing out every last inefficiency to keep prices low for you, the customer. Hashtag tag 2.4 store format and real estate strategy. The real estate strategy at B&M is also a really important, almost, unsung hero of their business model.
Location, location, location.
Exactly. They're incredibly deliberate about where they place their stores, strategically locating them in high-traffic, convenient areas to maximize visibility and accessibility for their target customers.
Makes sense. Be where people are.
No hidden alleyways here. And the format itself is constantly evolving. There's an increasing focus on opening larger stores, many of which even feature attached garden centers.
Ah, the bigger ones with the garden bit, yeah.
This approach allows them to offer a much broader product range, think more choice for you, and has been shown to drive significantly higher sales densities compared to their smaller, older formats.
More sales per square foot.
Right. They actively manage their property portfolio, often replacing older legacy stores at the end of their leases with these newer, larger, and more modern sites.
Upgrading the estate.
This continuous process of optimization ensures that their entire store estate remains productive, appealing, and relevant to customers. A direct result of this strategy is that the growth in total retail square footage often outpaces the net growth in the actual number of stores,
Interesting.
which is a key indicator of their underlying sales momentum. They're not just adding more stores, they're adding better, bigger stores.
Now, let's turn our attention to the leadership, because recent changes here are particularly noteworthy.
Oh, new faces.
Yes, and it speaks volumes about the strategic direction of the company. It's almost like a new chapter is beginning. Hashtag tag 2.5.1. New CEO, Tjeerd Jiggen. The appointment of Tjeerd Jiggen as Chief Executive Officer in 2025 brings a truly seasoned retail operator to the helm.
Okay, Tjeerd Jiggen. Experience.
Oh, yes. He arrives with 30 years of experience, including CEO roles at the Dutch retailer HEMA and senior leadership positions at major European retail conglomerates like Tesco, Ahold Delhaize, and Metro Group.
Wow, big names.
His deep expertise spans multiple formats: supermarkets, department stores, and discount retail. And he has worked across 9 different countries. This background makes him exceptionally well-suited to B&M's specific business model and its current strategic challenges.
Sounds like a good fit on paper.
This appointment isn't just a corporate reshuffle. It's a strategic SOS from the board, signaling a critical course correction is needed.
Okay, why? What was going wrong?
It's a direct and deliberate response to some of the company's recent operational headwinds, particularly the acknowledgement of negative like-for-like sales in fiscal year 2025.
Ah, the LFL dip.
Driven in part by subpar FMCG in-store execution. The departure of the previous CEO in early 2025, which notably coincided with some guidance cuts,
Never a good sign.
further underscored this pressing need for a change in leadership. So, the selection of a successor with Mr. Jiggen's specific hands-on experience in managing complex retail operations, with a mix of general merchandise and FMCG, is a clear signal from the board. It indicates a strategic prioritization of fixing core retail execution and navigating an increasingly complex international market.
Getting back to basics, maybe.
Exactly. Given these current operational headwinds, how truly crucial is a seasoned retail operator like Mr. Jiggen to B&M's immediate and long-term future? It suggests a deliberate, urgent shift in focus towards deep operational capability. Hashtag tag 2.5.2 CFO Mike Schmidt.
Supporting Mr. Jiggen on the financial side is Chief Financial Officer Mike Schmidt, who joined in 2022.
Okay, the finance guy.
Mr. Schmidt's background includes a CFO role at the publicly listed retailer DFS.
DFS, the furniture place.
That's the one. And he spent 13 years in corporate finance at top-tier investment banks like Citi and UBS.
Solid finance background, though.
This combination provides B&M with strong financial and strategic acumen, which is absolutely crucial for navigating expansion and meticulously managing their capital, especially as they enter this new strategic phase. Hashtag tag 2.5.3 Board of Directors.
And the broader board of directors ensures robust governance and a wealth of diverse industry experience.
Good oversight.
Its members have held senior roles at other major consumer-facing companies such as Pizza Express Imperial Brands, Procter & Gamble, and even Amazon.
Wow, Amazon too. Interesting mix.
This ensures a blend of retail, finance, and broad consumer expertise guiding the company through its next chapter.
With a clear understanding of B&M's structure and its new strategic leadership, let's now turn our attention to its financial pulse.
The numbers. Let's see how it's really doing.
What do the numbers truly tell us about its recent performance? And crucially, where does it stand financially today?
A detailed look at B&M's financials over the last few years tells a really interesting story. One of strong top-line revenue growth driven primarily by aggressive expansion, but also a rather concerning recent moderation in the organic health of its existing stores and a squeeze on overall profitability.
Okay. Growth, but maybe not the right kind of growth. Hashtag, tag 3.1.1 top-line growth drivers. So let's start with the headline figure, revenue. In fiscal year 2025, B&M's group revenue increased by 3.7% year over year, hitting a substantial $5.571 billion on a 52-week comparable basis.
Okay, $5.5 billion, up 3.7%. Sounds okay.
Now that sounds like a good, solid number, right?
Okay.
Growth is growth. But here's the crucial detail, the nuance that changes everything.
The cash.
This growth was almost entirely attributable to the contribution from new stores.
Entirely? What?
In fact, new stores alone added 6.9% to sales growth in the core B&M UK segment. This means that while the overall revenue pie got bigger, the slices from existing established stores weren't growing organically.
So the older stores are actually selling less or staying flat.
Exactly. It's like a marathon runner gaining distance by starting new laps, not by speeding up on the current one. Hashtag tag 3.1.2, the like-for-like concern. So if the top-line revenue looks healthy, but the engines of existing stores are actually sputtering, isn't that a bit like building a taller house on a shaky foundation?
That's a good way to put it.
How worried should we really be about that negative like-for-like performance? And what could be the hidden implications that aren't immediately obvious?
That's precisely the critical question, and it's the core message the numbers are shouting. Forget just overall revenue growth for a moment. B&M's financial report essentially shouts one core message. The company's aggressive expansion is, to some extent, masking a crucial underlying challenge to the health of its existing stores.
Masking the problem.
Our sources highlight that in FY25, B&M UK, the company's largest and most important segment, experienced a like-for-like, or LFL, sales decline of 3.1%.
Minus 3.1%.
Ouch. This is a sharp deterioration from the performance seen just a year prior in the first quarter of FY24, when the company reported a strong B&M UK LFL growth of 9.2%.
So a big swing downwards.
A very big swing. This negative organic growth points directly to significant headwinds. Management themselves acknowledged that this performance was below expectations.
They admit it.
Yes. And it was impacted by poor weather, the timing of Easter, low consumer confidence, and some specific internal challenges in their FMCG.
The groceries and stuff.
Or fast-moving consumer goods execution. It's a clear signal that something needs to be fixed at the operational level. Hashtag tag 3.1.3 profitability compression. On a more positive note, the company's gross margin has shown some impressive resilience, which is encouraging.
Okay, bit of good news.
In FY25, the group gross profit margin actually improved by 50 basis points, rising from 37.1% to 37.6%.
So the profit on each item sold is better?
Generally, yes.
Okay.
This improvement was primarily driven by a favorable product mix in the UK, with a relatively stronger performance in higher-margin general merchandise categories. So they're selling more profitable items within their overall basket.
Right.
However, despite this gross margin strength, the pressure on operating costs led to a slight compression in the group's adjusted EBITDA margin,
Costs are biting.
which decreased by 35 basis points from 11.5% in FY24 to 11.1% in FY25. This dynamic is further reflected down the income statement. Adjusted operating profit fell by 1.8% to $591 million, and adjusted diluted earnings per share saw a more significant decrease of 6.7% to 33.5p.
So profit per share down quite a bit. Why?
This decline is largely attributable to higher depreciation charges, resulting from the company's expanding asset base of new stores and infrastructure investments.
The cost of all those new stores hitting the books.
Exactly. What this interplay between metrics truly highlights is that while the more profitable general merchandise mix offers a lifeline, these strong gross margins are being undermined by operational costs and the rapid expansion itself, especially when organic sales are softer.
Right.
This underscores precisely why that like-for-like performance, how existing stores are performing, is so critical to true, sustainable profitability. Hashtag tag 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 3.1.4 key financial metrics. FY21, FY25 summary.
Now, instead of reading out a full spreadsheet of numbers, let's zoom in on the story these key financial metrics tell over the past 5 fiscal years.
Yeah, the trends.
What immediately stands out is that while B&M's overall group revenue has shown consistent growth, climbing from $4.8 billion in FY21 to over $5.5 billion in FY25,
The top line looks good.
the underlying health metric, like-for-like sales growth in their core B&M UK segment, has been a real roller coaster.
Ups and downs, mostly downs recently.
It swung from a huge 21.3% gain in FY21, only to plummet into negative territory in subsequent years before a brief rebound, and then that concerning negative 3.1% decline in FY25.
Very volatile.
This volatile organic growth, contrasted with steady, albeit moderating, overall revenue, truly highlights that new store openings are doing most of the heavy lifting.
Yeah, papering over the cracks, maybe.
Meanwhile, metrics like adjusted profit before tax and adjusted diluted earnings per share have shown a consistent downward trend over this period, reflecting the pressures on profitability we just discussed.
So less profit overall despite more sales.
Right. And while the company has generated significant cash from operations, its net debt has nearly doubled.
Doubled. Wow.
Climbing from $409 million in FY21 to $781 million in FY25, alongside a decrease in post-tax free cash flow.
So more debt, less free cash.
This paints a clear picture of aggressive expansion, which, while driving headline revenue, is increasingly capital-intensive and challenging its organic profitability. It's truly a business facing growing pains at a strategic inflection point.
Growing pains is a good way to describe it. Hashtag tag tag 3.2 balance sheet and cash flow. Despite these operational challenges, it's really important to stress that B&M maintains a strong and robust financial position.
Okay, so it's not all doom and gloom on the finance side.
Not at all. Management themselves characterize the balance sheet as having limited considered leverage, which is a prudent approach and provides significant financial flexibility.
Okay, so they're not overborrowed.
Seems not. For example, their debt-to-equity ratio was recently reported at 1.2, which is a moderate level and compares quite favorably to an estimated industry average of around 1.5.
Lower than average, that's good.
To put that in simpler terms, for every pound of equity, they have £1.20 in debt, which is manageable. At the close of fiscal year 2025, the key leverage ratio of net debt to adjusted EBITDA stood at 1.26 times.
Okay, 1.26x. Is that high or low?
It's considered comfortable. While this is a slight increase from the 1.17 times recorded in the prior year, it remains at a comfortable and manageable level, well within the company's financial covenants, indicating no immediate alarm bells.
Right, no red flags there.
Furthermore, the business model is still highly effective at generating cash. In FY25, cash generated from operations amounted to a substantial $784 million.
Nearly $800 million in cash from running the business. That's strong.
Very strong. The company's preferred measure of cash generation, post-tax free cash flow, was $311 million for the year.
Okay, $311 million free cash. You said that was down, though.
It was. Now, this figure was lower than the $382 million generated in FY24, but this decrease was principally due to a planned working capital outflow.
Planned? How so?
They strategically increased their stock holding to support the growing store network and invested in new supply chain infrastructure. So this isn't a sign of fundamental weakness, but rather an investment for future growth.
Spending money to make money, hopefully?
Exactly. Despite this year-over-year decrease in FCF, the underlying cash-generative capacity of the business remains a core strength that should not be overlooked. Hashtag 3.3 capital allocation and shareholder returns.
Now let's talk about where that impressive cash generation actually goes. B&M's capital allocation strategy is very clear and consistent.
Where do they spend the cash?
With a primary focus on reinvesting in the business to drive further growth, but also a very strong commitment to returning surplus cash to shareholders.
Okay, growth and dividends.
Yeah.
Hashtag 3.3.1, reinvestment for growth.
The top priority for capital is, predictably, the continued expansion of their store network.
More stores.
The company opened 70 gross new stores across the group in FY25 and has already guided for another 45 gross new openings in the UK alone for FY26.
Still pushing ahead with expansion.
This continued investment is underpinned by the highly attractive economics of new stores. They've demonstrated an average payback period of less than 12 months.
Wow, less than a year to get their money back.
Think about that for a second. They get their investment back in less than a year. That's a phenomenal return on capital, showcasing just how efficient their new store model is.
You can see why they keep doing it then.
It's a formula that has historically worked incredibly well. Hashtag tag Hashtag tag tag 3.3.2 shareholder returns.
Beyond reinvestment, B&M has a robust and impressive track record of shareholder returns, which is a key part of their investment story and definitely something shareholders appreciate.
Keeping the investors happy.
The company has returned a total of $2.1 billion to shareholders since the beginning of FY21 through a combination of ordinary and special dividends.
$2.1 billion, that's a lot.
It is. For FY25, the board declared an ordinary dividend of 15.3 pence per share, representing a 2% increase over the prior year, offering investors a notably high dividend yield compared to many peers in the retail sector.
So a decent income stream for shareholders.
Yes. A significant strategic development in this area is the company's planned redomicile from Luxembourg to Jersey.
Moving where the company is registered? Why?
Management has explicitly stated that a primary motivation for this move is to unlock the potential for buybacks, signaling that share repurchase programs could become a more regular feature of the capital return framework in the future.
Ah, so buying back their own shares. Another way to return value.
Exactly. It's a proactive step to enhance shareholder value.
So not only are they growing their physical footprint, but they're also sharing a lot of that financial success with shareholders and even planning for more ways to do it in the future. That's a strong vote of confidence in their financial health and future prospects from the management. Hashtag tag tag 3.4 key performance indicators, KPIs.
Two key performance indicators truly highlight B&M's underlying operational efficiency and profitability, even amidst those growing pains.
Okay, the efficiency scores. Hashtag tag 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 3.4.1 return on capital employed, ROCE.
One of B&M's standout financial characteristics is its ability to generate exceptionally high returns on the capital it employs. This demonstrates the efficiency and profitability of its investments.
How well they use their money.
Precisely. Their primary metric for this is return on capital employed, or ROCE. Think of ROCE as the ultimate efficiency score for a business. For every pound B&M invests in its operations, how much profit does it get back?
All right, so what's the number?
In FY25, the group's adjusted ROCE was 30.4%.
30%, is that good?
It's excellent. While this was a slight decrease from the 33.4% achieved in FY24, it remains at an exceptionally high level for a brick-and-mortar retailer.
Wow, okay. Very efficient then.
That's like a car that gets amazing mileage for every gallon of fuel, showing how incredibly efficient and profitable their store expansion model is when it's firing on all cylinders. Hashtag 3.4.2 return on equity, ROE.
Similarly, the company's return on equity, or ROE, is reported to be very strong,
Another return measure,
with one source citing a figure of 42.9%.
43%.
This indicates a highly efficient use of shareholders' capital to generate profits. In simpler terms, for every pound of shareholder equity invested, they're generating nearly 43 pence in profit, which is an undeniably impressive figure for any business.
Yeah, that's really high.
These strong financial fundamentals are definitely impressive, particularly the cash generation and those high returns on capital. But a crucial question remains: how does B&M truly stack up against its rivals in this fiercely competitive market?
Right. The competition. Let's get into that. An accurate analysis of B&M's competitive position absolutely requires a carefully defined peer group.
Need to compare apples with apples.
Exactly. It's crucial to focus on companies based on their business model, product category overlap, and geographic presence. We have to be smart about who we compare them to.
Right.
Our sources highlight the importance of dismissing inaccurate automated data that sometimes erroneously places B&M in, say, the aerospace industry.
Boeing.
Listing irrelevant companies like Boeing or various investment trusts as peers. That's just not helpful for understanding its real market position, and frankly, it's a waste of time.
Yeah, obviously.
So the truly relevant competitive set for B&M can be broken down into a few key categories.
Okay, who are they really up against?
First, the direct pan-European variety discounters. These are the most direct competitors, operating a similar low-price, high-variety, general merchandise-led model across multiple European countries.
Like B&M, but maybe bigger or growing faster.
Potentially. The most significant players here are the Netherlands-based Action and the Warsaw-listed Pepco Group, which operates the well-known Poundland and Deals fascists.
Ah, Action and Poundland Pepco. Got it.
Then we have off-price retailers, companies that sell branded goods at a discount. The primary competitor here is TJX Europe, which operates the popular TK Maxx and HomeSense chains.
TK Maxx, yeah. Different model, though, more brands.
Offering a slightly different twist on value. Next, UK grocery discounters. In its fast-moving consumer goods and food categories, B&M competes directly with the incredibly efficient German hard discounters, Aldi and Lidl,
And the big ones.
which have a significant and ever-growing share of the UK grocery market. And finally, traditional UK supermarkets.
Tesco, Sainsbury's.
B&M also competes for your wallet share with the major UK supermarkets, including Tesco, Sainsbury's, Asda, and Morrisons, particularly on household goods, ambient food, and seasonal items. It's a crowded playground.
Wow, so competition from all sides, really. Hashtag TACTEC 4.2 benchmarking against direct peers. Now let's take a closer look at how B&M measures up against its closest pan-European direct peers.
Action and Pepco mainly.
Right. The recent performance of these rivals truly reveals both areas where B&M shows resilience and where it's facing significant competitive pressure. And frankly, some of these comparisons are pretty eye-opening. Hashtag TACTEC 4.2.1 Action, Netherlands-based. Action, the Netherlands-based discounter, has emerged as a particularly formidable competitor, demonstrating an almost explosive growth trajectory.
Action's been on a tear, hasn't it?
Unbelievable. In its 2023 fiscal year, Action's net sales grew by an impressive 27.8% to reach $11.3 billion.
27%.
And this was supported by an exceptionally strong like-for-like sales growth of 16.7%.
16% LFL. Wow. Compare that to B&M's negative number.
Exactly. That momentum didn't slow down. It continued into fiscal 2024 with sales growing a further 21.7% to $13.8 billion, driven by a 10.3% LFL increase.
Still double-digit LFL growth. Incredible.
And their expansion has been relentless, adding 303 net new stores in FY23 and another 352 in FY24.
Just opening stores everywhere.
This combination of rapid footprint growth and consistent, strong, double-digit organic sales growth presents a stark and truly challenging contrast to B&M's recent negative LFL performance in its core market.
Yeah, it makes B&M look a bit sluggish in comparison, doesn't it?
It's like B&M is cruising along and Action just blasted past them in the fast lane.
Action's performance is incredibly telling. Their ability to deliver double-digit like-for-like growth while simultaneously rapidly expanding their footprint raises a critical question about B&M's current execution compared to a truly formidable competitor.
Are they doing something B&M isn't?
It suggests a certain level of dynamism, operational excellence, and customer resonance that B&M absolutely needs to emulate and recapture in its core operations. Shows what's possible in this sector. Hashtag 4.2.2 Pepco Group. Poundland, deals, die-ups.
Then we have Pepco Group, which operates over 4,600 stores under the Pepco, Poundland, and Deals brands.
Poundland, yeah.
How are they doing?
They offer a more nuanced, perhaps even a more sobering comparison. In its 2023 fiscal year, Pepco's revenue grew by a healthy 17% to $5.6 billion. Okay, 17% growth, pretty good.
However, much like B&M, the company faced significant challenges in the second half of the year, experiencing negative LFL sales and a subsequent profit miss.
Ah, so similar problems to B&M then.
Exactly. They attributed this to similar macroeconomic pressures and high inflation in their core Central and Eastern European markets.
Right.
For FY24, their revenue was $6.2 billion, a 10.2% increase, but group LFL sales were down 3.2%.
Minus 3.2%, virtually identical to B&M's UK number. That's interesting.
Which is eerily similar to B&M's UK performance. They also added 392 new stores.
Still expanding fast, too.
This parallel experience suggests that some of the headwinds B&M is facing are indeed industry-wide rather than purely company-specific.
So it's not just B&M struggling with LFL.
Though, as we said, that doesn't diminish the competitive threat. It just means everyone's feeling the squeeze, except maybe Action. Hashtag 4.2.3 TJX Europe. TK Maxx HomeSense.
And then there's TJX Europe, operating as part of the TJX International segment, which also demonstrates strong performance in the off-price category.
TK Maxx, yeah. They seem busy whenever I go past.
For its 2025 fiscal year, the segment reported net sales of $7.2 billion, a 6% increase year over year, with segment profit rising to $422 million.
Okay, solid growth.
In the final quarter of FY25, the division posted a robust, comparable store sales increase of 7%.
Plus 7%, that's strong too.
Highlighting the continued appeal and resilience of its off-price model for branded goods. It shows that there's more than one way to succeed in the value segment.
Right, different models working differently. To bring this into even sharper focus, let's look at the absolute essence of how B&M stacks up against Action and Pepco Group, focusing on the story the numbers tell.
Okay, the head-to-head.
What truly leaps out from the comparison is the stark contrast in growth momentum. While B&M's revenue grew a modest 1.6% in the last year,
Yeah, pretty flat.
Action delivered a stunning 21.7% growth, and Pepco came in at 10.2%.
Big difference.
But the most critical differentiator is like-for-like sales growth. B&M UK saw a modest 3.1% decline, while Action was soaring at plus 10.3%.
That Action number is just...
Oh, wow. Even Pepco Group experienced a similar nuggeter 3.2% decline, indicating a wider industry challenge. But Action stands out as a true outlier.
They're definitely doing something right.
When it comes to scale, B&M, with 12,055 stores, is significantly smaller than Action's nearly 3,000 and Pepco Group's almost 5,000 outlets.
So they're smaller and growing slower organically.
Right. And the pace of expansion is equally telling. B&M added 55 net new stores in the year, whereas Action and Pepco each added over 350.
Much faster rollout from the competitors.
This comparison truly reinforces B&M's position. While it has a strong base, its organic sales growth is significantly lagging behind a key competitor like Action, which is also expanding at a much faster rate.
Yeah.
This underscores the urgency of B&M's strategic focus on revitalizing its core UK business. They're not just competing, they're trying to catch up.
A lot of pressure on the new CEO then. Hashtag tag 4.3 positioning in the UK market.
Now, let's hone in on B&M's home turf, the UK market, and how it strategically positions itself. Hashtag tag 4.3.1 competition with grocery discounters and Big Four. Within the UK, B&M's competitive positioning is multifaceted, almost like a chameleon.
Fighting on multiple fronts.
On its extensive, fast-moving consumer goods, or FMCG, ranges, it competes directly with the incredibly efficient German grocery discounters, Aldi and Lidl.
Tough competition there.
To defend its market share in these categories, B&M has to maintain a really sharp price proposition and offer a compellingly different product mix, often rotating items to create excitement.
The treasure hunt again.
They also compete directly with the traditional Big Four supermarkets, that's Tesco, Sainsbury's, Asda, and Morrison's, particularly on household goods, ambient food, and those crucial seasonal items.
You might pop into B&M for cleaning stuff instead of Tesco.
Exactly. B&M's ability to maintain a clear value advantage is critical here. The company asserts that it consistently maintains a price gap of 15–20% against these traditional grocers.
15 to 20% cheaper. That's significant.
Which is a key pillar of its customer proposition. That's a significant saving for shoppers. Hashtag had tag 4.3.2 traction with higher income demographics.
A particularly noteworthy trend, highlighted in the company's recent communications, is its growing traction among higher-income consumer demographics.
Oh, really? Not just budget shoppers?
Apparently not.
Yeah.
In the fourth quarter of FY25, B&M saw its greatest market share gains among households with an income profile of £50,000 to £100,000.
50 to 100 grand, that's comfortably middle class and up.
Exactly. Now, here's where it gets really interesting. This indicates a successful trade-down effect, where more affluent consumers, feeling the pinch of the ongoing cost of living crisis, are actively seeking value at discounters.
Even if they don't have to, they choose to.
Precisely. Seeking value for both their discretionary and non-discretionary purchases. It's not just budget shoppers anymore. Even higher-income households are flocking to discounters.
That's a big shift.
That's a powerful signal of fundamentally changing consumer habits and represents a significant opportunity for B&M to expand its customer base beyond traditional value shoppers and capture market share from more mainstream and even mid-market retailers.
Broadening their appeal.
Value isn't just for the budget-conscious anymore, it's for the financially savvy.
With a clear picture of its market, its rivals, and these shifting consumer habits, let's now explore B&M's strategic plan to secure its future and address these dynamics head-on.
Yeah, what's the plan? They clearly can't stand still. Hashtag tag 5. Strategic growth vectors and operational outlook. Hashtag tag 5.1. The 4 channels of growth. B&M's management has articulated a clear, multi-channel strategy for driving long-term growth.
Okay, what are the channels?
This strategy carefully balances the continued expansion of its physical store footprint, a tried and tested method, with the increasingly critical need to improve the performance of its existing estate.
So new stores and fixing the old ones.
Exactly. Our sources suggest that B&M's growth narrative is currently being tested, as the historical model of relying primarily on new store openings to drive revenue is proving insufficient in the face of those negative organic growth figures.
Can't just keep opening stores if the existing ones aren't performing.
Right. The company must now demonstrate its ability to execute a more complex strategy that involves both sophisticated operational improvement and careful international expansion.
More juggling involved.
This framework, then, is built upon 4 distinct pillars, each intended to contribute to overall growth in revenue, profit, and cash flow. Hashtag tag 5.1.1 new UK stores. The continued rollout of new stores in the UK remains a central plank of the growth strategy, And for good reason.
Because the payback is so good.
Precisely. The company has set an ambitious long-term target of operating at least 1,200 B&M UK stores, which would represent an increase of more than 50% from the current estate of 777 stores.
1,200 stores, that's a lot more.
The financial rationale for this expansion remains highly compelling. New stores opened between FY23 and FY25 have demonstrated that average capital payback period of less than 1 year,
Incredible returns.
making it a highly attractive and efficient use of capital. The company plans to open another 45 gross new stores in the UK in FY26.
Still going for it then.
While this has been a proven formula for success, generating those fantastic returns, a critical question for the long term is the potential for market saturation
Running out of good spots.
and the risk of cannibalizing sales from existing stores as the network becomes denser and more mature. At some point, how many blue storefronts can one town take?
Good question. Hashtag tag track 5.1.2 positive like-for-like sales. This is perhaps the most pressing challenge and honestly the biggest opportunity for the company right now.
Fixing the LFL number.
Right. Management explicitly recognizes that driving positive like-for-like sales from the existing store base is absolutely crucial for generating highly profitable growth.
Because it costs less than opening new stores.
Think about it. Each 1% increase in LFL sales is estimated to be equivalent to the profit contribution of opening 7 new stores.
7 stores for every 1% LFL gain.
But without any of the associated capital expenditure or increase in fixed costs, given the recent negative LFL performance of -3.1% in the UK in FY25, reversing this trend has quickly become the company's most significant and urgent strategic challenge.
Job number 1 for the new CEO, surely.
It's the low-hanging fruit with the biggest potential impact on their bottom line.
This really begs the question. Can B&M move beyond merely expanding its footprint and truly reignite organic growth within its existing store base?
Can they do it?
The economics of LFL improvement are so compelling it's essentially free profit growth that it truly is a make-or-break area for the new management team under Geert Jagen. Their ability to deliver here will be critical to the company's overall health, profitability, and ultimately its future valuation. This is where the rubber meets the road. Hashtag tech check 5.1.3 France expansion.
Then there's France. B&M France is strategically positioned as the company's primary long-term international growth engine.
The big international play.
Management has benchmarked the potential scale of the French market against that of the UK, suggesting a substantial runway for future store openings.
So they think France could be as big as the UK for them.
Potentially. The performance of this segment actually provides a vital strategic offset to the current weakness we've discussed in the UK.
So France is doing okay.
In FY25, the French business delivered positive LFL sales growth of 2.6%.
Plus 2.6%.
Okay, that's positive at least.
Demonstrating that the value proposition is resonating with French consumers. The continued successful execution of the French rollout is now critical to maintaining the company's overall long-term growth narrative.
Takes some pressure off the UK.
But of course, expanding into any new international market always carries inherent execution risk, cultural differences, logistical challenges, new competitors. It's a calculated bet. Yeah, international expansion is never easy. Hashtag tag 5.1.4 Heron Foods. Finally, we have Heron Foods. This discount convenience chain is considered a long-term growth opportunity.
Smaller convenience stores.
Its performance in FY25 moderated after 2 years of exceptional growth, but it remains a strategic asset in the convenience segment of the value market.
Okay, so maybe not stellar growth now, but still important.
Offering a complementary angle to the larger B&M stores, particularly for quick, food-focused shopping.
This multifaceted strategy signifies an important inflection point for the company. For years, the primary growth story was simply the rapid and highly profitable expansion of the UK store network.
Just keep opening stores.
But the FY25 results, with their negative UK LFLs, clearly signal that this model alone is no longer sufficient to sustain the kind of growth investors expect.
The game has changed.
Management's response, then, represents a necessary pivot from a purely expansionist mindset to one that also requires sophisticated operational turnaround skills.
You need to be good at running stores, not just opening them.
The investment thesis has thus become more complex, now resting on a multifaceted strategy that requires fixing the core UK business, successfully scaling the French operation, and maintaining discipline at Heron Foods. It's a challenging balancing act.
A lot for the new team to handle. Hashtag 5.2, addressing operational weaknesses, FY26 initiatives. In direct response to that disappointing LFL performance, B&M's management has outlined a series of specific tactical initiatives planned for FY26 aimed at improving execution at the store level and reinvigorating organic growth.
Okay, so what are they actually doing about it?
These actions demonstrate an acute awareness of the operational shortcomings and a clear, detailed plan to address them, almost like a surgical strike. Hashtag 5.2.1 FMCG execution. To specifically address the underperformance in fast-moving consumer goods, the company is undertaking a full visual merchandising reset.
Making the shelves look better.
Essentially, yes.
Yeah.
This includes a rationalization of the product range in categories like health and beauty to reduce clutter and make shopping easier. You know, that feeling of being overwhelmed by too many choices.
Definitely. Less is sometimes more.
They're fixing that. Simultaneously, they're allocating 25–30% more space to high-performing categories, such as cleaning products, where demand is consistently strong.
More space for what sells well. Makes sense.
The food ranges will also be relayed, and additional chiller units will be installed to enhance the fresh and chilled offering, which is a key area for convenience and repeat purchases.
Better food displays, more chilled stuff.
Okay. This is a very targeted, hands-on approach to fix specific in-store issues that have directly impacted performance. Hashtag 5.2.2 General Merchandise Price Architecture.
Another key area for improvement is their general merchandise price architecture.
How they price the non-food stuff.
Right. After a period in FY25 where average selling prices, or ASPs, in general merchandise actually declined.
Selling cheaper things or discounting.
Possibly both. The company is conducting a thorough review of its good, better, best pricing tiers. Think of this as how they differentiate prices for basic, mid-range, and premium versions of similar products, for example. A basic watering can versus a more premium, durable one.
Right, offering different quality levels.
The goal here is strategic. They want to enhance certain departments with higher price points and introduce more well-known brands to help restore those average selling prices and appeal to a wider range of customer needs.
Trying to get people to spend a bit more.
Especially those higher-income consumers who are now trading down from other retailers. It's a smart move to optimize both pricing and product mix, reflecting their evolving broader customer base.
Catering to the new shoppers. Hashtag 5.2.3 Supply Chain and Retail Operations. Finally, B&M is continuing to invest in its supply chain infrastructure to support both growth and improved efficiency.
Getting stuff to the stores better.
This is complemented by a renewed and relentless focus on core retail standards at the store level, encapsulated by the simple yet crucial mantra of ensuring products are available, clean, and ticketed.
Back to absolute basics. Stock on shelf, clean store, right price.
This is the fundamental blocking and tackling of retail. They explicitly recognize a direct correlation between high store standards, how tidy and well-stocked a store is, and positive LFL performance.
Makes sense. You buy more if the store looks good and has what you want.
It's a reminder that sometimes the most sophisticated strategies come down to executing the basics flawlessly.
So what's the net effect here? B&M is clearly aware of its challenges and has a detailed, almost granular plan to tackle them head-on.
Sounds like it.
From what you see on the shelves to how things are priced to the very basics of store operations, it's an all-encompassing effort that aims to truly transform their operational performance.
Let's hope it works. Hashtag tag outro.
So as we wrap up our deep dive into B&M European value retail, let's quickly recap the powerful strengths that underpin this company and the significant challenges that now demand its unwavering attention.
Okay, the summary.
Strengths first.
On the strength side, B&M has a fundamentally robust foundation. Its low-cost, capital-light business model has proven to be incredibly effective at generating substantial cash flow and delivering impressive returns on capital, with ROCE still at a very healthy 30.4%.
High returns. Good cash flow.
It holds a strong market position, especially in the UK, and is well-placed to continue benefiting from that enduring consumer shift towards value that we discussed.
Right place, right time, in theory.
Its disciplined store expansion program has been a powerful engine of growth, and the economics of opening new stores remain highly attractive.
The new stores still work well financially.
And crucially, this financial strength has enabled a consistent and generous policy of returning capital to shareholders, which is a key feature of its investment case.
Good dividends. But as we've thoroughly explored, these historical strengths are now being truly tested by a series of pressing challenges.
The but.
The most critical is the urgent need to reverse the negative like-for-like sales trend in its core UK market. That negative 3.1% in FY25 signals that the company can no longer rely on footprint expansion alone to drive growth.
Can't just build their way out of it.
It must now prove its ability to enhance productivity and sales densities within its mature estate. This task is made even more difficult by an intensely competitive landscape.
Yeah, action breathing down their neck.
B&M faces formidable, well-capitalized, and rapidly growing peers, most notably Action, whose recent organic and expansionary growth has significantly outpaced B&M's.
Big challenge there.
And finally, while the expansion into France represents a significant long-term opportunity, it also carries inherent execution risk as the company seeks to replicate its domestic success in a new and complex market.
France needs to work. Stepping back, B&M has a robust foundation, but it's clearly at a strategic inflection point. Its historical strengths are now truly being tested by a much more demanding market and a critical need for sophisticated operational tweaks.
A real turning point.
So what, for you, the listener, is this? B&M's future value creation is going to depend squarely on the new leadership's ability to execute a complex, dual strategy.
Get the UK sorted and make France work.
Exactly. This involves a much-needed turnaround in its mature UK market, reinvigorating those existing stores, combined with the successful and careful execution of its international growth in France. It's no longer just about opening new stores. It's about making every single store count and excelling operationally.
So, as you consider the future of discount retail, here's something to mull over. In a world where value is increasingly prized by all income brackets and competition is fiercer than ever,
Yeah.
how long can a brick-and-mortar giant like B&M truly thrive without a significant digital presence, relying primarily on its physical footprint?
The online question again.
What do you think stands out as the biggest determinant of its success moving forward? The answers might surprise us.
Good question to ponder.
We hope this deep dive has given you a shortcut to being exceptionally well-informed on B&M European value retail and the fascinating dynamic world of discount retail.
Hopefully useful.
Keep asking questions, keep digging, and keep learning. We'll be back soon with another deep dive.